Hello everybody. In this session we are talking about financial ratios. Financial ratios are created with the of numerical values taken from financial statements to gain meaningful information about a company. The numbers found on a company's financial statements, like balance sheet, income statement, and cash flow statement, are used to perform quantitative analysis and assess the company's liquidity, leverage, growth, margins, profitability, rates of return, valuation, and more. And then, why are financial ratios so important? Financial ratios are sometimes referred to accounting ratios or finance ratios. These ratios are important for assessing how a company generates revenue and profits using business expenses and assets in a given period. Internal and external stakeholders use financial ratios for competitor analysis, market valuation, benchmarking, and performance management. Often, financial ratios are considered the best indicator of a company's financial health, which explains why it's so important to understand these ratios and what their results mean. And then we move to uses of financial ratios. The financial ratio can be used in two different forms. The first, analyze from performance. This performance is evaluated with trend analysis, calculating an individual's ratio on a per-term basis and tracing its worth over time. This analysis is used to find out the source for pending receivables, its average collection time, and a decrease in organization liquidity status. And then the second, relative performance comparison. Here, the comparison is between a company's profit with the other competitors. And then we move to the types of financial ratios. The first, liquidity ratios, measure a company's ability to meet its short-term obligations with its current assets. And then the second, profitability ratios, measure a company's ability to generate profits relative to its revenue, assets, and equity. And then third, coverage ratios, measure a company's ability to manage its debt obligation. Fourth, efficiency ratios, measure how a company can use its assets and resources efficiently to generate revenue. And fifth, market value ratios, measure a company's performance relative to the market and its peers. It's important to note that no single ratio can provide a complete picture of a company's financial performance, and ratios should always be analyzed in context with other financial data and industry benchmarks. And then, what are some misconceptions about financial ratios? Despite their usefulness, financial ratios can sometimes be misunderstood or misinterpreted, leading to misconceptions. One common misconception is that a single financial ratio can provide a comprehensive overview of a company's financial health. In reality, financial ratios should be analyzed collectively, considering various factors such as industry's norms, company size, and growth stage. Another misconception is that higher values for all ratios indicate better performance, while high ratios may generally indicate favorable financial health. Excessively high ratios can also signal financial issues. For example, a very high debt to equity ratio may indicate excessive leverage and financial risk. Additionally, comparing financial ratios across different industries or sectors can be misleading. Each industry has its own unique dynamics and financial requirements, making direct comparison challenging. It is crucial to consider industry-specific benchmark and numbers when analyzing financial ratios. And then we move to interpreting financial ratios. When analyzing financial ratios, it is essential to consider the context of a company's industry, size, and stage of development. A high or low ratio may not always indicate good or bad performance. Therefore, comparing ratios with similar companies and historical trends is crucial for a more accurate assessment. Additionally, it is vital to analyze multiple financial ratios and not really on a single ratio for a comprehensive understanding of a company's financial health. Financial ratios should also be used in conjunction with other forms of analysis such as cash flow projections and market trends. And then we move to key challenges in interpreting and analyzing financial ratios. There are a few challenges that businesses may face during this process. The first, industry comparisons. Comparing financial ratios across industries can be challenging because different industries have varying business models or structures and operating dynamics. Ratios that are considered favorable in one industry may not be appropriate for another. Therefore, it is essential to understand the industry's norms and benchmark when performing the interpretation of financial ratios. And second, accounting methods and manipulation. Differences in accounting methods and practices can impact the calculation of financial ratios. Ensuring that the financial data used for ratio analysis is consistent and comparable is important. Additionally, businesses need to be cautious of potential financial manipulation or creative accounting practices that can distort the ratios and mislead the analysis. And then the third, lack of historical data. financial issues are more meaningful when analyzed over time. However, businesses face challenges of and if they lack sufficient historical data to establish trends and make meaningful comparisons. Limited historical data can limit the ability to identify patterns and accurately assess the business performance. I think it is enough for this session. Thanks for watching and don't forget give this channel with your like, comment, subscribe and share. Thank you.